This is the lecture or instructional video on adjusting accounts. Adjusting entries are done at the end of the period, and that could be the end of the month, the end of the year, the end of the quarter, for what we call deferred expenses and revenues and accrued expenses and revenues. So with our deferred expenses and revenues, this is when we actually record the expense or revenue. We record that after we've paid the cash. And so, for example, when we're talking about a prepaid expense specifically, this is prepaid because we've already paid the cash before we've incurred the expense. And so when we paid that cash, we recorded it as an asset. And in that case, we recorded as an asset in the prepaid expense account. Prepaid expenses are assets. And so now as we incur or as we use or the prepaid expires, then we want to recognize the actual expense. We want to recognize the actual expense. And we do that by doing an adjusting entry. I'm going to abbreviate that. And so that's what we're going to be looking at here, adjusting entries. And so, for example, we could have a prepaid insurance or a prepaid rent. And in your video, you looked at an example of a prepaid rent. And so, as a prepaid expense. And so, the adjusting entry for that is that we would debit the insurance, or if we're talking about rent, expense account. Hence, we would recognize that by debiting the expense account. And then we would credit that prepaid insurance, which was your asset or your prepaid rent. And so if you look in your book at Quick Study 3-5A, and that's on page 126, they say the prepaid insurance account had a $4,700 debit balance to start the year. And so a review of the insurance policies and payments shows that $900 of unexpired insurance remains at the end of the year. Remember, this adjusting entry is going to recognize how much has expired. And so they tell us that if we started with $4,700 and we have $900 that hasn't expired. So if we started with $4,700 minus the unexpired of $900, that means that $3,800 has expired. So we would do that entry for $3,800. We would debit insurance expense and we would credit prepaid insurance. Also, if you look at Quick Study 3-5B, if you read that one, it tells us that the prepaid insurance account had a $5,890 debit balance at the start of the year. At the start of the year. And a review of the insurance policies and payments shows that $1,040 of insurance has expired. So they tell you how much is expired, so you don't have to do any calculation. And so you would do that entry for $1,040. You would debit insurance expense and credit prepaid insurance. Another prepaid or deferred expense is supplies. When we purchase supplies, we record it as an asset. So when we purchase supplies, we debit supplies and we credit cash or however we purchase it. Then that doesn't look like a good word. And so as we use it, we want to expense it. It becomes an expense as we use it up. And so we would debit supplies expense and we would credit supplies. So we're recognizing the expense and we're reducing the supplies by how much we've used up. And so if you look at quick study 3-6, quick study 3-6, and if you look at B, let's look at B. B says the supplies account has an $800 debit balance to start the year. Supplies of $2,100 was purchased. So if I started off with $800 in my supplies account and I purchased $2,100 of supplies, that gets me to $2,900 of supplies in the account. And then if you go on and read the problem, they said at December 31st, the physical account of supplies show that they only have $650 remaining. So if I subtract $650 from that, that leaves me $2,250 of supplies left. I'm sorry, that's been used. This was what was left. So this is what was used. And so remember that entry is for how much has been used. So we would do the entry for $2,250. So we would debit supplies, expense, and credit supplies. Okay. Another kind of deferred expense, prepaid expense we look at is depreciation. We look at depreciation. Depreciation, I started writing the definition down for you. And if you look at it, it says that depreciation. Okay, depreciation is the process of computing and recognizing an expense for the cost of using a plant asset. So that's what depreciation is. And so basically what we're doing is, this is where we write off or allocate the cost, and I'm sorry about the writing of this pen, but it's just difficult, the cost of the plant asset. And we write it off over its useful life. We write it off over its useful life. So there's a calculation, and in this particular chapter, we look at our straight line method. So we look at the straight line method, and our formula for that is that we want to take our cost of the asset, and we want to subtract from that the salvage value. And then we want to divide it by the useful life. And this is basically our years. So our salvage value is basically what we think we can get for it. And the book will give you that after you've used it for the number of years that we think is useful. And so that's our useful life. So once we do that calculation, this gives us what we call our annual amount of depreciation. And I'm going to abbreviate depreciation. And basically, when I say annual, I mean for a 12-month period. So how much we want to record for our annual depreciation of 12 months. The entry that we do for depreciation is we would debit depreciation expense, and we would credit accumulated depreciation. And I'm going to abbreviate that. Accumulated depreciation is a new account. I'm going to pull a T account under here that you haven't seen before. And it is what we call a contra asset. So it is an account that decreases an asset. So it's the opposite of an asset account. It increases on the credit side and decreases on the debit side. And so it's a contra asset because when we record it in the balance sheet, it offsets the actual asset or depreciates or decreases the actual asset. And so let's look at just a quick problem, quick study 3-8C. We want to look at C. Quick study 3-8C says the company has only one fixed asset equipment that was purchased at the start of the year. The asset had a cost of $32,000. It had an estimated life of 7 years, and they expected salvage value is $4,000 at the end of those 7 years. So if we put that into our formula, we would take the $32,000 minus the $4,000 salvage value, and we would divide it by 7 years, and we would get $4,000. So we would debit depreciation expense for $4,000 and credit accumulated depreciation for $4,000 every year. We would do that every year. And so that is how we record our depreciation. And then our last is our unearned or our deferred revenue. Our unearned or deferred revenue. This is where we receive cash before we've done the work. And so when we receive that cash, we recorded it as a liability because we have a liability to perform the service because we've already been paid. And so as it is earned, we're going to record it as a revenue. And so what we would do is we would debit an unearned revenue account, and then you would credit the actual revenue. And so let's look at quick study 3-10. Let's look at quick study 3-10. And quick study 3-10, let's look at C, the last one. It tells us that on September the 1st, a client paid $24,000 cash for 6 months of rent in advance. The client leased a building and took occupancy immediately. The company recorded the cash as an unearned rent revenue. So what they did was they debited cash and they credited unearned rent revenue when they first paid it. So we have $24,000, and we want to divide it by 6 months, so that means we're earning $4,000 a month. And we did this on September the 1st, so that means we earn September, October, November, and December, 4 months of rent. We want to multiply it times 4, and we get $16,000. So this entry would have been a debit to unearned rent revenue for $16,000 and a credit to rent, let's be specific, revenue for $16,000. So that's what they would do to recognize it. And so this is the first video, and it covered deferred expenses and revenues.